Welcome back to another portfolio review video, and this is going to be a little bit later of an update as things got a bit busy this past month. So this is going to be a review for the month of May, but there is a reason for this as something important happened recently that I'll have to explain in a separate video coming up. I think I also included too many details in this video, so that as well added to the time it took to put this together. But in any case, ever since the March 30th bottom, the markets have just continued to go straight up with easing tensions and global conflicts, and a very strong earnings season. Portfolio-wise, I know I made a video on my 2026 portfolio reveal, but since then I've made a few big changes where I started transitioning out of my Harvest single stock ETFs. Don't worry, I'm still sticking to the plan I've outlined in that video, but I have decided to go back to another provider to focus more on the total return side of things. I'll get into all of the exact details later on when we get to the accounts, but if you want to make sure you don't miss out on a future video, consider subscribing and helping the channel reach 5,000 subscribers by the end of the year. We are now officially halfway through the year, so the time is flying by quickly to reach this goal. Thanks in advance, and now let's get into the review. So, starting first with the TFSA account. This is all recorded after the market close on Tuesday, May 26th for context. Here, you'll see the account value chart, where you can visually compare the growth of the portfolio value relative to the net deposits in the account. A lot of the account history is described in great detail inside the last portfolio review video, so I'm not going to go over it again here. If you'd like more context, then you can watch that video afterwards. But as I'm now maxed in terms of contribution room, the deposits here won't be changing until we get more room for 2027. Now, switching over to the returns chart and to the one-day return, the account was down $724.31. On the 1 week, it has been a gain of $3,450.09. Then for the 1 month, it has gained $8,735.44. For the 3 month, the increase was $15,848.69. And year to date, the portfolio has gone up $13,375.52, or 11.45% so far. As a callback to the objective of this account I mentioned in the 2026 portfolio reveal video, the TFSA is intended to form the core of my core and satellite approach. And as such, the goal here is to match or slightly beat the S&P 500 index in terms of performance. If I pull up the S&P 500 performance so far year to date, from the start of the year to May 26th, it has increased 9.63%. So this account year to date has aligned with my goal of matching or slightly beating the S&P 500 index by 1.82%. But because the portfolio skews a bit more towards the technology side of exposure, I can also pull up the NASDAQ index to compare. And it looks like year to date, the NASDAQ from January 1st to May 26th is up 14.72%. So I would say that this portfolio is performing exactly as intended, where the returns are in between the S&P 500 and the NASDAQ index. Just a side note to include here as well, is that the indexes do contain dividend-paying companies, so that isn't included here in the price return performance. It's not much, but it is worth noting just in case, so that you're aware. Now taking a look at the 1 year, the portfolio has gained $16,494.97, or 14.51%. And all time, it's been a $15,897.07 gain, or positive 13.91% overall. In terms of portfolio value, it is currently at its all-time highs. For percentage, this might appear a bit low given how the market has performed over the last year, but you'll see in this next part a more accurate reflection of the account's performance inside the Performance Insights section. So that's where we'll head to next. Here you'll see that the account value is at $130,190.23, with $114,293.16 in net deposits. The all-time return is $15,897.07, with $9,529.95 of it being unrealized. Now for the overview section, we have the simple return rate and time-weighted return rate. For those who are not familiar with these two rates, you can hover over the information icon here. With the simple return rate, it's the most straightforward, where it is based on how much your holdings have grown compared to what you've deposited. So this number is the same as we saw before at 13.91%. The time-weighted return rate is where it does some more math, and calculates how your investments have performed with the effects of deposits and withdrawals removed. and then any periods longer than a year are annualized. So typically this will be the more accurate rate you want to use and gauge your portfolio's performance by. And as you can see, the value is a return of 18.68% annualized for this account, which goes to show how my recent contributions to the account have appeared to dilute a bit of the overall portfolio's performance. Without those contributions, the simple return rate of 13.91% would be higher and closer to the time-weighted return rate of 18.68%. Just keep in mind that the time-weighted return rate is an annualized rate, meaning it shows the speed of your growth over a year, and not the actual percentage of dollars you've made so far. Below, we then have the realized return all time, and also the dividends earned all time. I'm going to skip over the realized return all time, because I've already explained it in the previous video, but it was as a result of making some changes to my holdings at the time. For the dividends earned all time, it's now at $6,844.60 in the account. The desktop version isn't as nice, but if I pull up the mobile version, for the month of May, the total distributions received in the account were $1,307.08. You can see the highest paying holdings were QDAY at $331.80, HHIS at $275.40, and HYLD at $207.70. Then we have INT at $150.80, HDIV at $96.20, HPYE at $88.20, and then PayG at $84.40. I don't consider PSA an actual holding as it's just a high interest savings ETF, to earn some interest while I wait to deploy the cash a bit more opportunistically. So, over the course of a month, I earned $57.18 in interest or distributions. At the end, we then have HEQL with $9.60, and then CLSA with $5.40, because I had just started this position since the last portfolio update. I decided to include CLSA here to mainly increase the Canadian exposure within the portfolio, but the returns have also been great in the past year. Chris Cullen, who I've recently interviewed on this channel about their new PayG ETF, wrote a recent post on CLSA and its current discounted opportunity, giving some context, along with some reasons to consider it. So, if you're interested in this ETF, I give it a quick read to understand it a bit better. The TFSA currently only has HDIV for my Canadian exposure, so I think this is a great complement to it in a sector with a very long track record. I'll have some more context in the Spreadsheets section later on in the video, where you can see how it currently all fits in the broader portfolio. But for now we can go back to the main page, and I'll scroll down so you can see all of the holdings and their current values. The only thing I'd like to point out is the cash position I have with PSA. Since the last video, the value has been reduced by $7,255.62, which isn't by too much, as I'm still waiting for a better opportunity to deploy the cash. But at the same time, I don't want to completely be on the sidelines if the market just continues to run up without me. As for all the other holdings, I'll go over them in more detail when we get to the Spreadsheets section. So you can pause here if you'd like, but in the meantime, we'll now switch over to the non-registered account to also see its performance. Again, we'll start with the account value chart, where you can visually compare the growth of the portfolio value relative to the net deposits in the account. Feel free to watch the previous video afterwards if you'd like to learn more about the account history. But when compared to the TFSA, it's worth mentioning that the non-registered account here is meant to be my satellite positions, where it holds all my single stock investments, along with crypto and some higher risk holdings. So comparatively, the overall day-to-day changes of the numbers could fluctuate a bit more both ways. Now that being said, we can switch over to the returns chart, and for the one-day return, the account was down $1,617.62. Then for the past week, it was up $810.86. In the past month, it was up $6,094.88. And then over the previous 3 months, it has increased by $16,933.88. Year to date, the portfolio has gained $10,891.64 so far, or 10.10% overall. Again, compared to the S&P 500's performance of 9.63% year to date, the non-registered account here is outperforming it slightly by about 0.47%. Compared to the Nasdaq, which is up 14.72% year to date, it is underperforming by about 4.62%. Crypto, of course, has continued to be a drag on the portfolio, and some of the Mag 7 single stocks I have haven't performed as well either, when you compare it to other areas that are closer to the AI build-out. So this portfolio is sitting between the two indexes so far when it comes to performance, which is not as high of returns as I would like, but it comes with the territory of placing more riskier holdings together. At the very least, it is still ahead of the S&P 500, so I consider it to be an acceptable performance overall so far. Moving on to the 1 year, the account has gained $22,922.47, or positive 23.93%. Then finally, all-time it is currently at its all-time highs, with a $48,575.55 gain, or positive 69.25% return overall. This is the original and first investment account I've ever managed, so I'm excited for the day we get to see a 100% return on here. Now we can go to the performance insights section like before and see some more details. Here, the portfolio value is $118,725.68, with the net deposits made into the account being $70,150.13. This has since produced an all-time return of $48,575.55, with $2,083.66 of it being unrealized. As for the simple return rate, as we saw earlier, is 69.25%. Then, for the time-weighted return rate, it is at 11.38% on an annualized basis. The reason for this drastic difference is mainly due to the age of this account and how long it has had to compound. I started this account in July of 2022, which is roughly 46 months ago. Over this time, the account has had time to grow in terms of dollar value, as you can see in the 69.25% simple return rate. But how this time-weighted return rate of 11.38% fits in comparison, we would need some more numbers in order to contextualize it all. If I put this rate in a chart starting with $10,000, at inception, the time-weighted return rate and simple return rate would be 0. Then, at the end of year 1, if the return is the annual rate of return of 11.38%, the $10,000 would then become $11,138. Over the course of the next 5 years, if this continues at a consistent rate of 11.38%, the account value would have then grown to $17,140, or a 71.40% simple rate of return. Because I've only had this account for 46 months, or approximately 3.8 years, the 69.25% return is actually ahead of the schedule, and goes to show both the timing of my investments and compounding of distribution reinvestments have mostly worked out so far, translating to this accelerated growth. There's just some math that goes into contextualizing the values you see, and can use to understand portfolio performance. Hopefully this has helped a bit to improve that understanding, and that you now can reflect better upon your own portfolio's performance. If this is the case, consider subscribing and liking the video so that I know it's worthwhile to continue including this kind of information into future videos. Okay, enough math, and let's move on to the realized return all-time and dividends earned all-time sections. In the realized return all-time, I've actualized a total of $13,363.96. I don't do any trading in this account, so this has all been from making adjustments in terms of the portfolio's holdings. Then, for the dividends earned all-time, I'm going to pull up the mobile version again, because it shows the distributions better in terms of each month. So, in the month of May, I received a total of $1,829.17 in distributions. The highest paying holdings were TSLY with $206.15, BCCL with $179.69, QQCL with $145.25, and NVHE with $141.25. There are 19 total holdings in this account, so I'm just going to scroll down slowly to the bottom so you can also see some of the lower distributions as well. Here at the bottom, we'll have JPHE at $76.72, HBTE at $66, GOGY at $45.30, and then CNYE at $18.26. For this account, there's no real goals for income as most of these are single stock ETFs. When it comes time for reinvestments, I'm mostly looking at those who are the most discounted at that point in time when it comes to my decision making. It's important to keep this in mind, because even though these are primarily income-based products, only a smaller portion of it is used to generate the distributions. A majority of it is still exposed to the underlying stocks, so for total returns, the timing does matter a bit more when you're reinvesting in single stock ETFs. Next, let's go back and see the exact holdings I have in this account and what changes I've made since the last update. So here we have all of the holdings in this account. There are quite a few, so I'll be showing this again in much greater detail and accuracy later on in the spreadsheet section. So don't worry if you can't catch all of this in time. But scrolling down further is where you'll find the most recent changes I made, and those would be the additions of YAMZ, YNVD, and YTSL. I also ended up doubling up my position in YGOG by selling out of GOGY. Technically, these additions are not new, and I've previously had all three of these in the account before, but I had swapped all of them over to the Harvest single stock versions when they were released. Most of it was for the unhedged aspect, because all the purpose ETFs are Canadian dollar hedged, but a part of it was also for the yield. For my personal situation, where I have some more time before retirement and would like to focus a bit more on the total returns, I've now decided to eventually convert all my single stock ETFs back over to purpose ETFs. Even though I had switched all my other single stock ETFs to Harvest, I've always held on to the last one in YGOG and was unable to fully let go because of its strong performance, questioning myself if it was the right choice to do so. Well, after a year or so now, and doing some comparisons, generally because of Purpose's covered call strategy, there is just a bit more upside capture overall when it comes to the total returns. That's not to say Harvest ETFs are bad when it comes to performance. In fact, depending on the market environment, many of them are performing very well. But for me, I've just decided to switch back to Purpose for all my single stock investments. So as you can see, so far I've swapped over to YAMZ, YNVD, and YTSL for the single stocks, because they were already up and in the green, so I could make use of the gains for more shares. For JPHE, METE, MSHE, and NFLY, I'll continue to hold until they come back into the green, before also switching them over to their purpose equivalents. I'm excited for this change, and look forward to seeing their performance over time. Now with both accounts covered, we can switch over to the spreadsheet dashboard for the full picture, and total return details when they are combined together. Okay, here we will see the personal dashboard that I've built to track the combined portfolio of the TFSA and non-registered accounts together. As usual, at the top we have the overview section that shows the day profit and loss and total profit and loss, which are the unrealized returns on the 1 day and all time on the combined accounts. So on the 1 day, the account saw a loss of negative $2,341.54, while the total unrealized gains are at $10,652.21. Next to it, we have the total return, which is the amount the portfolios have grown by and has gained since I started them. What that means is if I sold everything right now, I would have profited $64,542.61 from my investments. And then for the yield, because the market has gone up in this past month, it has lowered now to 19.83%, which I think is more in line with where I'd expect it to generally be. At the end, here is then the annual dividends, which is what I can currently expect to receive each year for distributions. This will change depending on distribution increases and decreases, or when I reinvest distributions. So you can expect this number to generally grow over time, and right now it's at $37,783.98. Keep in mind, I also still have a large cash position in my TFSA, so once it is fully invested, I'd expect us to easily surpass $40,000 and reach closer to $50,000 by the end of the year. Zooming in a bit now to go over the rest of the spreadsheet, the combined portfolio value has now grown to $248,873.54. The total deposits are $184,333.87, with $211,970.81 currently invested into the markets. As for the composition and returns, I can pull up the one from the last video so you can compare. The main changes are already as I mentioned, where I swapped the single stocks in TSLY, AMHE, and NVHE for their purpose investments equivalents in YTSL, YAMZ, and YNVD. Then the only brand new addition would be CLSA from Brompton, where I included it within my Canadian allocation. All of the other holdings in the portfolio then stayed the same. Scrolling down, we can get some context to how the returns in this portfolio are broken down, relative to how much I've actually deposited of my own money. So, with the $184,333.87 I deposited, the investments have returned a total of $64,542.61, or 35.01%. And of that 35.01%, $44,425.77, or 24.10% of that is from all the distributions I've received. $10,652.21, or 5.78% of that is in the form of unrealized gains. And then $9,464.63, or 5.13% of it, are actualized gains from swapping out of positions in the portfolio. As a majority of the investments in the portfolios are in covered call ETFs, this is likely what you can expect, where a significant portion of it is in the form of distributions. Then, below is another breakdown of the returns, but based on the individual sectors I showed above. Crypto is of course the worst performing one again, where it is the only sector in the red. The best performing one is then the exchange traded fund sector, where it contains all my more diversified or index-based ETFs. This is typically expected, as these all form the core positions in my core and satellite approach. Though in the last video, the technology sector was actually outperforming the exchange traded fund sector due to how much they have rallied since the bottom of the markets in March. But here this is no longer the case, as I sold some of those holdings during the swap, so that's just some context to keep in mind. Going back up a bit, the next section we'll look at is the recent performance comparison. Here you can see the trend comparison to the S&P 500 index as a benchmark through various time periods. This overview helps me to identify how the portfolio is doing relative to the index, and whether or not this type of portfolio can outperform over time, or if it would just be better to hold the index itself. So on the one day, the portfolio has underperformed the index by 1.55%, and that is largely due to some tech and crypto selling off today. As a lot of the single stocks in portfolio is concentrated around these two themes, overall it can experience some more volatility. Then on the 1 month, the portfolio has outperformed the index by 1.20%. On the 3 month, this outperformance has accelerated with an 8.60% difference. For the 6 month, the portfolio is then ahead of the index by 5.96%. And then year to date, it has doubled the performance of the index, with outperforming it by 10.92%. As for all time, the portfolio's performance is 35.01% since inception, compared to the index's 90.09%. But as mentioned in previous videos, and in the additional details box shown here, this is based on a single one-time lump sum investment, and doesn't accurately reflect a portfolio that sees additional contributions to it over time. And this is especially true for this year, where the portfolio itself basically doubled from my consolidation of TFSA accounts into Wealthsimple at the start of the year. So this isn't something I look at as a direct comparison, but just more so as a reference of how much the index has increased since I started investing. And as I'm making this, I'm wondering if it's worthwhile to just dash this out so that I don't have to keep explaining it in every video. I'm just thinking out loud, and this is probably something I'll consider for the next video. So overall, I think the portfolio has continued to perform very well so far, and is doing what is intended based on how it has been put together. Then next is my favorite part, and that is where all of the holdings are ranked based on the various metrics that I like to look at. The first is the ranking based on allocation sizes, and this is where you can really see a person's convictions based on how much is allocated to each holding. So for myself, you'll find more of the core, diversified, and index-based holdings here at the top. These mostly form the core allocation of the portfolio, where they will continue to get added to over time so that they will stay at the top of this list. Then all of the sector-based and single stock holdings will follow behind in this middle section. And then, below that will be all the newer or more speculative positions, along with all the growth-based positions that don't pay distributions, as this is primarily a covered call ETF portfolio. Next, for the unrealized gains, the top holdings are YGOG, ACT, QDAY, Bank, HYLD, ENCL, QQCL, and HDIV. These are a mix of some of my core holdings, and also some of the longer held holdings in the portfolio. Then for the ones in the negative would be to no surprise, mostly the crypto holdings in Leith, BCCL, and MSTE. There's also some single stocks that have underperformed lately in MSHE and NFLY in between. In the next column over are the annual distributions, and this is where we can see which ones are the highest paying holdings across the portfolios. At the top is QDAY with $4,320, HHIS with $3,304.80, YTSL with $2,750.40, and then HYLD with $2,601.60. Then at the bottom, we have holdings which don't pay any distributions, but for the ones that do, they are HBTE with $806.40, CNYE with $219.12, CLSA with $209.52, and then HEQL with $115.20. After this column is the lifetime dividends, where it is all the distributions that I've collected while owning each holding. At the top of the list is HHIS with $2,809.19, then Bank with $2,478.60, QQCL with $2,365.53, and then ENCL with $2,252.56. All of these are some of the longer held holdings within the portfolio, so that's mostly why they are here at the top. I'd expect some of the higher yielding ones to eventually outpace these over time, so the order of this will likely change in the future. Then at the bottom are a bunch of holdings that either don't pay distributions, or I haven't received them yet as they are newer to the portfolio. Finally, the last column will be the most important, and that is the list of total returns. This combines both the unrealized returns, along with the lifetime distributions that have been received for each holding to get the total return percentages. With investing in covered call ETFs, it's important to keep this in mind to track and understand your return performance. At the top though, we actually don't have a covered call ETF, but instead, an individual stock with ACT, returning 204.35% currently. It is then followed by YGOG with a 101.55% return, which should actually be a return of over 200% as well. But with the consolidation of GOGY into YGOG, it halved the total returns, because I basically doubled my position or amount invested. Then we have Bank and ENCL, which are both Canadian sector-based ETFs that have performed very well and continue to do well this year. For Bank, it has been a 77.87% total return, and for ENCL, it has been a 55.78% total return. Then we have HBTE at 33.02%, QDAY at 29.66%, HHIS at 27.92%, QQCL at 22.79%, and QQQL at 21.70%. Many of the ones I just listed have been in the portfolio for at least a year or more, but the last one I mentioned in QQQL was actually started only this year. This is a NASDAQ 100 base growth focused ETF that doesn't pay any distributions, but it uses an additional 25% leverage to increase its performance. To have a 21.70% return over the course of 5 months so far is quite impressive, and certainly deserves a mention and look into if you are looking for a more hybrid portfolio and not just having only income-focused ETFs. On the other end of the spectrum are the ones with negative total returns, and the ones in the double digits are NFLY, BCCL, CNYE, MSTE, and LETH. 4 out of 5 of these are crypto related, so that is pretty self-explanatory. The other one in there is Netflix, which appears to have sold off significantly after backing out of the Warner Bros. Discovery deal. While it's not ideal to see it down so much, it can be seen as an opportunity to average into it and pick up more shares at a discount. With the crypto holdings, I still continue to average into them each month, but only with distributions and not any new cash I add to the account. It's a sector that is certainly out of favor right now, with AI and other areas currently capturing more of the capital inflows. So this will definitely be a more longer term investment and outlook if you're looking to get into crypto right now. In the last section at the bottom here, I have a chart of the dividends and distributions that I've received since I started investing. It's a little hard to see since the chart is getting a bit full, but currently the projected monthly distributions are at $3,148.67 per month and steadily growing. By the end of the year, I'm expecting for it to reach close to $4,000 a month once the cash in my TFSA is fully invested, and also throughout the distribution reinvestments for the remainder of the year. With this chart, you can visually see that over time, there's a compounding effect that develops slowly over time. I think once the portfolios generate enough recurring distributions, where I'm satisfied with the rate of compounding, I may eventually reassess and tilt the portfolio more towards growth. And that is one of the benefits I appreciate, where there is that flexibility to reconfigure your portfolio without having to overhaul it once you have it already established with this strategy. Hope you all found this helpful as I try to make these as insightful and transparent as possible. If you could like and subscribe, that would let me know to continue making these going forward. Thanks for watching, and I'll see you in the next video.